The question today is, should you try timing the market? Well, you probably know the answer, but if the market have a sign saying that they're open from 6 a.m. to 8 p.m., that probably the time you should go. With the market hitting all-time high every other day, and we've been in the longest bull run in history, with the last longest bull run only last 113 months, and right now we at 131 months, make you wonder, should you try timing the market? To answer this question, let's take a closer look of the S&P 500 chart. Right now we're looking at the weekly chart of the S&P 500. That means each candle right here you're looking at represent 1 week. And as you can see, we've been going up non-stop the last couple of weeks. And from the bottom to the top, we going up around 33%. Now, do you guys catch that? That chart right here is actually not the current time chart. This is back in 2016 and 2017. Look very familiar with the current chart, right? The current chart for the S&P 500 actually look like this right now. Very similar, right? If you're in the market during that time and been going up non-stop since the correction 33%, do you think it continue going higher? You probably said yes, because you already know the outcome. But let's say if you were perfectly timed the bottom since the last correction in 2016 and your portfolio go up 33% within a year. Now, knowing the fact that the average return for the S&P 500 is only 10%. Now, would you consider to take profit? If you said yes and decide to take the profit and wait for the market correction, you probably feel good about yourself knowing that in next couple of weeks, the stock market did make a small correction of 3%. That 3% probably boosts your confidence a little bit, but it probably will not get you back into the market. So now you're just sitting on the sideline with all that cash, waiting for the next market correction just to get back in, only to find out the market keep grinding higher and higher months after months. You start questioning about your decision about timing the market. You went online and saw some quote saying that time in the market is better than timing the market. You get impatient and decide to get back into the market. That right there costs you 13% gain from your portfolio, not even include the dividend that you could have received. The market went up a little bit more. You then feel like you make the right decision about not trying to timing the market. You swear to yourself that you're never gonna try to time the market again. A couple weeks later, the market dropped more than 10% within 2 weeks. Headline about recession is coming start to pop out everywhere, and you start questioning about your decision again. Now, do you see the pattern that I'm trying to show? When you try to timing the market, you enter this endless realm of keep doubting yourself, questioning every single decision that you make. But honestly, that is how most average investors think.
How would you know what the average investor think?
Because I am one of them. This study showed that if you have $2,000 to invest every single year for 20 years, and you were able to perfectly timing the market in each of those years, that means you invest $2,000 at the lowest price every single year for 20 years. From 1993 to 2012, you would end up with $87,004. Another scenario is you invest that $2,000 at the beginning of the year as soon as you receive it. By the end of 20 years, from 1993 to 2012, you would end up with $81,650. The third scenario is you dollar cost averaging that $2,000 for the 12 months. For 20 years, now from 1993 to 2012, you would end up with $79,510. Now the next scenario is you just super bad at timing. Every single time you try to enter the market with that $2,000, you enter at the worst time, which is the highest price for that year. Even for that, for 20 years, you would end up with $72,487. Now, what really surprising me about this study is even you were able to perfectly time the market for 20 years. That's basically almost impossible. It is impossible. You would only make 6% more over the 20-year period compared to the person who just invested money right away. And compared to the one that had worse timing in the market for 20 years, you only make 16% more than them for the 20 years period. Now you're probably questioning, it probably only happened during those exact time, which is in 1993 to 2012. But the study showed that going all the way back to 1926, 68 of the 20 rolling period, 58 out of 68 of the period, the result was the same. You may argue that that's not timing the market because you still invest every single year. Well, let me show you something, but first, I just want to say this spreadsheet right here that I'm about to show you, I got it from Investing with Rose, another finance channel on YouTube. She have great information about finance. For the first scenario, we call it the perfect timing scenario. In this scenario, you keep saving up all that cash, waiting for the market correct more than 20%, and you're able to invest in at the perfect time at the very bottom. That means from 1998 until now, you will invest 4 times, which is in 1990, 2000, 2007, and the last pullback in 2018. Another scenario is you invest that $500 as soon as you receive it at the beginning of the month, every single month. For the first scenario, where you got perfect timing, you would end up with $1,235,760. And the second scenario, where you just dollar cost averaging, you would end up with $1,183,224. The results are pretty crazy, right? Because after perfectly timed every single recession for 31 years, you only end up with 4% gain for 31-year period. That is not even calculating the dividend that you would receive if you did not hold your money in cash. With that calculated, you probably underperform compared to the person who dollar cost averaging. Now, you probably think that 2 or 3% dividend is not gonna matter because the stock gonna decrease by 20 to 30%. But do you know that 43% of the total market return from 1930 until 2018 was coming from dividend? Even more shocking is 82% of the total market return from 1960 until now is from dividend. Maybe you should consider dividend investing. And yes, that is all the information I got for you guys today. Let's pick out our giveaway winner for this week. Start. Okay, just wait a little bit. Still going. Winner is Godox Jonas. Okay, I probably pronounced that wrong, I'm sorry. And to show that I'm not giving away the LED strip just because it is cheaper than the silver coin, so I'm just gonna pick out another winner just to make up for the price that being cheaper than the silver coin. And let's see who the next winner is. The next winner is Badass on the Planet, right? Badass on the Planet, yes. Anyway, like usual, to claim the prize, the winner had to contact me. If none of the winner contact me, the prize will give to the next person for the next video. So this week we're gonna go back to the silver coin giveaway. To enter the giveaway, comment below, like the video, and hit the subscribe button. Thank you again for watching until the end. My name is Kyle, your average investor, and you guys have a blessed day.